There is a date quietly sitting on the calendar that most Americans will scroll right past. No breaking news chyron, no front page headline, no primetime anchor is going to lead with it tonight. And yet, when historians look back at this particular era in American economic history, that date, July 1st, may be remembered as the moment the rules of money started to change in a way that the Federal Reserve, the Treasury Department, and every too big to fail bank on Wall Street desperately hoped you would never figure out. What I want to talk to you about today is not a prediction. It is not a theory. What is happening right now in state houses across this country, in the vaults of central banks from Beijing to Budapest, in the quiet conversations happening between treasury officials in nations that control the majority of the world's natural resources, what is happening is the most significant monetary shift since 1971, and it is accelerating. And July 1st is one of the clearest proof points that this shift is not coming. It is already here. Let me show you what I mean. Cast your mind back to a moment in history that most people alive today either barely remember or were never taught in school. It's the early 1970s. Inflation is eating American savings alive. The Vietnam War has been financed with printed dollars rather than real tax revenue. Foreign governments, France in particular, have grown suspicious of American monetary promises. They start showing up at the door of the Federal Reserve and the Treasury with crates full of American dollars, demanding gold in exchange. Because that was the deal. Since Bretton Woods in 1944, the dollar was supposed to be as good as gold. Every dollar in circulation was supposed to represent a fixed amount of gold sitting in reserve. But the problem was, the United States had printed far more dollars than it had gold to back up, and everyone was starting to figure this out. On August 15th, 1971, President Richard Nixon went on television. He announced what economists now call the Nixon shock. He closed the gold window. He told the world the dollar would no longer be convertible to gold. Just like that, in a Sunday night television address, 5,000 years of monetary history was set aside. Gold and money were officially divorced. The dollar became, for the first time in its history, backed by nothing but trust in the United States government. And for a while, that seemed to work fine. The dollar remained the world's reserve currency. Oil was priced in dollars, debt was denominated in dollars. America could print money to pay its bills in a way no other country could, because every country needed dollars to participate in global trade. This became known as dollar hegemony, and it was the most profitable financial arrangement the world had ever seen for the United States. But here is what no economics textbook will tell you plainly. That arrangement is unraveling right now, in real time, and July 1st is part of the story. See, what happened in the years after Nixon's announcement is that gold went on a rampage. In 1971, gold was officially priced at $35 per ounce. By 1980, it had surged to over $800 per ounce. People who understood what that Nixon announcement really meant, that the dollar was now a faith-based instrument, that its purchasing power would be slowly eroded by monetary expansion, that real tangible wealth needed to be held in something that governments could not print, those people saw their wealth preserved and multiplied. Everyone else watched inflation ravage their savings, their pensions, their retirement funds. Now, here we are again. Gold has done something in the recent market environment that even the most ardent gold bulls had trouble fully forecasting. The price trajectory has been extraordinary, at one point surging well past $5,000 per ounce, a figure that would have seemed like science fiction to most investors just a few years ago. Think about that. In 1971, gold was $35. Today, it is measured in the thousands. And yet, somehow, most Americans still hold virtually none of it. Most retirement accounts are stuffed with paper assets, stocks, bonds, mutual funds, while the actual monetary metal that has held its value across every civilization for 5,000 years is treated as a fringe investment. But something is changing, and that is where July 1st comes back in. What most Americans do not know is that states across this country have been quietly, methodically passing legislation to restore gold and silver to their rightful place as legal money. Utah was the first modern state to do it. They passed the Utah Legal Tender Act, recognizing U.S. minted gold and silver coins as legal tender within the state. Then came Louisiana, Oklahoma, Texas, and others. State legislatures started doing something remarkable. They started acknowledging, in writing, in law, what every central banker quietly knows. Gold is money, real money, and paper currency is simply a promise. West Virginia passed their precious metals legislation, and it became effective on July 1st. That date, July 1st, marks the day that in that state, precious metals taxation was eliminated. The rationale was simple and profound. You do not tax money. When you exchange one form of money for another, there is no taxable event. A dollar exchanged for another dollar at a bank does not trigger a capital gains tax. And if gold is truly legal money, then exchanging dollars for gold should be treated the same way. West Virginia's legislature understood this, and the law went into effect on July 1st. This is not a small symbolic gesture. This is a state government officially signaling that the game has changed, that gold is not a commodity, that gold is not a speculative investment. Gold is money. And when you remove the tax barrier to holding and transacting in gold, you fundamentally change the equation for every saver and retiree in that state. Now think about what happens when this movement, which has been quietly building across more than a dozen states, reaches critical mass. Think about what happens when the legislative momentum combines with what central banks are already doing. Let me tell you about the other story hiding in plain sight. Central banks around the world have been buying gold at a pace that has no modern precedent. The institutions that run the global financial system, the very same institutions that spent decades telling the public that gold was a barbarous relic, that it had no place in a modern economy, that only conspiracy theorists and doomers held physical gold, those institutions have been quietly accumulating it hand over fist. Poland, Hungary, China, India, Russia before sanctions, Turkey, Singapore, nation after nation has been adding to gold reserves with urgency that does not match the official narrative that everything in the global economy is just fine. You have to ask yourself the obvious question. Why would the institutions that manage the world's largest fiat currency systems be buying the one asset that represents an alternative to fiat currency? Why would they accumulate gold if gold were truly irrelevant? The answer is that they know exactly what gold is. They have always known. They hold it because when, not if, the current system faces its next major stress test, gold is what survives. And look at who is making the most aggressive moves. The BRICS nations. Brazil, Russia, India, China, South Africa, and a growing coalition of allies have been openly discussing a framework for trade settlement that moves away from the dollar. For decades, this was dismissed as wishful thinking, but the momentum has shifted. When major oil-producing nations start accepting payment in currencies other than the dollar, when trade deals are structured in yuan or rubles or through a new multilateral framework, the global demand for dollars weakens. And when demand for dollars weakens, their purchasing power erodes. And when purchasing power erodes, the people who get hurt most are the ones holding dollar-denominated savings, which means retirees, pensioners, and ordinary working Americans who did everything right and saved their whole lives. There's a name for this dynamic that the financial press rarely uses in polite company. It is called de-dollarization, and it is not a theory anymore. The data is unmistakable. The share of global reserves held in US dollars has been declining for years. The number of bilateral trade agreements being settled in non-dollar currencies has been declining for years. The SWIFT system, which the United States has used as financial leverage over nations that step out of line, is increasingly being routed around. The geopolitical tectonic plates are shifting, and gold is the one asset sitting on solid ground underneath all of it. Here's an analogy that might crystallize this for you. Imagine you have been playing a board game with a group of people. You are the banker. You control the money supply. Every time you need more, you can print it. For decades, every other player accepted this arrangement because you had made the rules, and the game seemed fair enough. But over time, the other players start noticing that you have been printing extra money for yourself when no one was watching. They start whispering to each other, they start making side deals, and slowly, quietly, they start moving their most valuable pieces off the board and into their own pockets, where your printed money cannot reach. That is what is happening in global finance right now, and gold is what they are putting in their pockets. Before I go deeper into where all of this is heading, I want to pause for just a second, because if any of this is resonating with you, if you are sitting there thinking about your own retirement savings and wondering what protects you from all of this, I put together a free guide. It is in the description below. It covers the saving strategies that thousands of American retirees are using to protect the wealth they worked decades to build. Take a look when you get a chance. It might be the most valuable thing you read this month. Now, let me take you back to 1980, because this is where the historical parallel gets genuinely alarming. By 1980, the combination of the Nixon shock, years of money printing to finance government deficits, the oil embargo of 1973, and a Federal Reserve that had kept interest rates too low for too long had produced something that most Americans at the time had never experienced: runaway inflation. Not the kind of inflation that annoys you at the grocery store, the kind that destroys retirement accounts, the kind where a pension that was supposed to provide comfortable golden years suddenly cannot cover the basics, the kind where everything your parents told you about saving money, about being responsible, about trusting the system, all of it feels like a cruel joke. Gold, as we noted, went from $35 an ounce in 1971 to over $800 an ounce by January 1980. The people who had gold were largely fine. The people who had only dollar-denominated savings were not. It is that simple. Then Paul Volcker, the Federal Reserve Chairman, raised interest rates to nearly 20%. It was brutal medicine. It caused a severe recession, it crushed the housing market, but it did eventually break inflation's grip, and gold pulled back from its peak. Here is the critical question that every serious analyst is asking right now. The conditions that produced the 1970s inflation episode, loose monetary policy, deficit spending, geopolitical disruption, and energy crisis, declining confidence in the dollar, are not just present today. They are present and amplified. The national debt is orders of magnitude larger than anything Volcker faced. The Federal Reserve's balance sheet expanded dramatically following the financial crisis of 2008, and then again during the pandemic response. Interest rate manipulation has been more sustained and more extreme than anything in the prior era. And unlike 1971, when the dollar was still the unchallenged global reserve currency with no viable alternative, today there are credible challengers. Gold hit its all-time high not because speculators got excited. Gold hit its all-time high because the people who actually understand monetary systems, central banks, sovereign wealth funds, institutional investors managing generational wealth, quietly concluded that the risk profile of paper assets has fundamentally changed. They are not buying gold because they think the world is ending. They are buying gold because they understand that what is happening to fiat currencies is structural, not cyclical. A cyclical problem is a recession that eventually turns into a recovery. A structural problem is a change in the underlying rules of the game itself. And right now, the rules of the game are changing. This is why the legislative movement to restore gold as legal money is so significant. It is not just a political statement. It is not just a symbolic gesture by some libertarian gestures who like the gold standard in theory. It is a response to reality. It is state governments looking at the macro picture and deciding to give their citizens an option, a financial off-ramp, a way to hold real, tangible wealth in a form that has never gone to zero, never been debased to nothing, never required trust in a politician or a central banker or a treasury official to maintain its value. Utah, Louisiana, Oklahoma, Texas, West Virginia. More and more states are waking up to this. And July 1st represents not just a single law taking effect, it represents a date in the broader story of gold's return to its rightful status. A date that marks the ongoing, accelerating recognition that the financial establishment's insistence that paper money is superior to gold was always, at its core, a self-serving narrative built by institutions that benefit from controlling the money supply. Now, let me walk you through what this means practically for the paper gold versus physical gold distinction, because this is where most people get confused, and the confusion is extremely costly. When most Americans think about owning gold, if they think about it at all, they think about gold ETFs. They think about GLD, the exchange-traded fund that supposedly holds gold on your behalf. Maybe they think about gold mining stocks. They read the ticker and see the gold price moving and assume that their exposure to gold through these instruments is equivalent to holding gold itself. It is not. Not even close. Here is what most investors do not understand about the paper gold market. For every single ounce of physical gold that exists in the world, there are an estimated dozens of paper claims on that same ounce. The COMEX, which is the primary futures exchange where gold is priced and traded in the United States, operates on the assumption that the vast majority of contracts will be settled in cash rather than in physical metal. The London Bullion Market Association runs a similarly leveraged system. What this means is that the price you see quoted for gold on your phone right now reflects the price of paper promises, not necessarily the price of actual physical gold sitting in a vault with your name on it. In a normal environment, the difference between paper gold and physical gold is manageable. The market functions, settlement occurs. But what happens in a stress scenario? What happens when confidence in paper assets cracks? What happens when enough people decide they want delivery of actual physical metal rather than a cash settlement? Ask anyone who tried to buy physical gold coins or bars during a period of major market stress. They will tell you about premiums above spot price, about weeks-long wait times, about dealers running out of inventory entirely. The paper price and the physical price can diverge dramatically. And in the scenario where gold's legal status is being actively restored, where more and more states are treating gold as money, the demand for physical gold is going to increase in ways that the paper market is structurally unable to accommodate. This is the core insight that the financial establishment does not want retirement age Americans to internalize, because it points directly to physical gold, held in forms that are actually accessible, as the most rational wealth protection strategy available. Not gold ETFs, not mining stocks, physical gold, real metal, the kind of wealth that has survived the fall of Rome, the debasement of medieval European currencies, the hyperinflation of Weimar Germany, the collapse of the Soviet ruble, the crises in Argentina and Zimbabwe and Venezuela. Every single time in history that a government has overreached with its monetary policy, gold has preserved the wealth of the people who held it. Let me also tell you about one more piece of this picture that is almost never discussed in mainstream financial media, and that is the Fort Knox question. For generations, Americans were told that their nation held the largest gold reserve in the world in the vaults at Fort Knox, Kentucky. The official figure is over 8,000 metric tons. The Federal Reserve and the Treasury cite this gold reserve as a backstop for confidence in the American financial system. The only problem is that Fort Knox has not been subjected to a full, independent, transparent public audit in decades. The last comprehensive audit most historians agree was genuinely independent occurred in the 1950s. Since then, there have been internal audits conducted by agencies that report to the same government that owns the gold. There have been congressional requests for independent auditing that have gone nowhere. Why does this matter? Because at a time when gold is being reasserted as legal money in state after state, at a time when the global monetary order is being renegotiated, at a time when the question of what actually backs the dollar is more urgent than at any point since 1971, the question of whether the gold that supposedly anchors American monetary credibility is actually there, all of it, accounted for and unencumbered, is not a conspiracy theory. It is a legitimate audit question. And its unanswered status is one reason why central banks around the world would rather hold gold they can physically touch, in vaults they personally control, than rely on any paper promise, no matter who signs it. This is where all of these threads converge. The legislative movement making gold legal money state by state, the central bank accumulation happening at record pace, the de-dollarization trends reshaping global trade, the structural vulnerabilities in the paper gold market, the unresolved questions about America's actual physical gold holdings, the historical parallels to every prior era in which fiat systems reached the limits of their credibility. All of it points in the same direction. Gold is not a speculation. Gold is not a commodity play. Gold is not something you put a small percentage of your portfolio into as a hedge while you keep most of your wealth in paper assets managed by institutions with a financial interest in keeping you fully invested in the fiat system. Gold is the foundation. Gold is the form of wealth that survives whatever comes next, whatever shape it takes, however long it takes to arrive. And for people approaching retirement, for people who have spent 30 or 40 years building wealth, for people whose financial security depends on that wealth holding its value across the coming decade, what is happening right now, what July 1st represents in this broader story, is not academic. The choice you make about how to protect your wealth, whether it sits in paper instruments subject to the same systemic risks that are playing out in slow motion across the global financial system, or whether some portion of it is anchored in real, physical, legal money that no central bank can debase, is one of the most consequential financial decisions of your lifetime. And here is the thing that really keeps me up at night when I think about retirement age Americans specifically. The people who are most vulnerable to what is unfolding are not the wealthy. The ultra-wealthy have advisors. They have diversification strategies, they have access to financial instruments and physical assets and real estate and business ownership that insulates them from the worst of what monetary debasement can do. The people who get hurt most when the purchasing power of paper money erodes are the people on fixed incomes. the people drawing from pension funds, the people whose entire financial security is denominated in dollars that are, by design, worth a little less every single year. This is not a scare tactic. This is arithmetic. The Federal Reserve has an explicit inflation target. They openly state that they want prices to rise every year. They use language like price stability to describe a policy that, by design, erodes the purchasing power of your savings over time. 2% inflation per year sounds modest, but over 20 years of retirement, 2% annual inflation cuts the purchasing power of your fixed income stream roughly in half. And if inflation runs hotter than 2%, as it has done in recent years, as it has historically done during periods of fiscal excess, the damage compounds even faster. Physical gold does not have a 2% annual inflation target. Physical gold does not have a central bank deciding on its behalf how much it should be worth next year. Physical gold is not a promise. It is not a claim. It is not a liability on someone else's balance sheet. It is wealth in its most fundamental form. And right now, at this extraordinary moment in monetary history, with state after state formally recognizing it as legal money, with the most sophisticated institutional investors in the world accumulating it as fast as they can, the window to act, to actually position yourself on the right side of this monetary shift, remains open. If you are sitting on over $100,000 in a retirement account, an IRA, a 401k, a pension, and you have been watching the headlines about gold prices and global monetary shifts and wondering what any of it means for you specifically, I want you to check the description below. There is information there about a free, no-obligation educational web conference. It is reserved for American retirees who are serious about understanding how to protect and potentially grow retirement wealth in this environment. If you mention that you watched all the way to the end of this video, you qualify for a one-on-one session that is not available to the general public. The one condition is that you have at least $100,000 in any retirement account, because the strategies being discussed are specifically calibrated to that situation. The link and all the details are below. But here is what I want you to walk away with today, regardless of whether you take that next step or not. July 1st is a date, but what it represents is a trend. And that trend is the slow, steady, unstoppable reassertion of gold as real money in a world that has spent more than 50 years pretending that paper promises are an adequate substitute for real value. The states that have already passed gold legal tender legislation did not do it on a whim. They looked at what is happening to the dollar's purchasing power, what is happening to the global reserve currency system, what is happening to the geopolitical balance of power that underpins dollar hegemony. And they decided to give their citizens an option, a real option. Every institution that has spent decades telling you that gold is old-fashioned, that it has no yield, that you should trust the financial system to manage your wealth, every one of those institutions is either quietly buying gold themselves right now, or they will be, because they do not have a choice. The monetary math catches up with everyone eventually. The question is simply whether you are positioned ahead of it or behind it. Gold hit prices this cycle that a generation ago would have seemed impossible. From $5,000 highs that stunned even veteran market analysts, it has pulled back, consolidated, and continues to represent a monetary asset whose fundamental case has never been stronger. And silver, the other monetary metal that has historically moved even more dramatically than gold once monetary recognition catches up with market reality, sits in a position that many analysts describe as the most compelling asymmetric opportunity in the precious metals complex. July 1st is not just a date on a calendar. It is a marker in the story of gold's return, a story that is still in its early chapters, a story whose ending is written not in the financial models of Wall Street firms, but in 5,000 years of human history that say, without exception, when paper fails, real money endures. And real money is already becoming legal tender, one state at a time, one July 1st at a time. The question is whether you will be holding it when the rest of the world finally catches up.